into financial markets explained, and we're basing this off of my book, This Way to Wall Street, which is my debut book, Guide to Getting Started. And today we're going to be reviewing the financial markets. We're going to be looking at some tools that we're going to use to analyze the financial markets, and then we're going to get to some of the good stuff like the Amazons and the Teslas and the Apples of the world. So thank you for joining, and let's get into it. So the first slide is there is no right, there is no wrong, there just is. And you know, that's applicable to anything in life, whether you're playing sports or anything that's performance related. There's no single way to approach these things. There's a multitude of perspectives and a multitude of applications. So what we're talking about today is definitely not the only way to approach the markets, but it is a practical way to approach the markets. So the itinerary today, we're going to be going over terminology, approaching the markets, instrument analysis, the financial industry, investor psychology, portfolio management, and then we're going to follow up with a question and answer. So some of the key terminology that we're going to be discussing today is a bar chart. So a bar chart is a visual depiction of price action. So a lot of us, we've looked at a chart before. You may have Robinhood or Webull or some other type of application. And a lot of times there's going to be a couple of ways that information is going to be displayed. Oftentimes you're going to see a line chart, but we're going to start off with the bar chart first today. So a bar chart contains an opening price, which is a left hash on the bar, a closing price, which is the most important price of the day, on the right hash, and then you have a daily high and a daily low. Now a candlestick chart is just a little bit more visual depiction of the battle between bulls and bears, but it still contains the same price information. So when the candle is green, your open is at the bottom and your close is at the top. When your candle is red, your open is at the top and your close is at the bottom. And candlesticks are a real good way of really looking at that battle between the buyers and the sellers and see who won the battle for the day, the week, or the month. I'm going to skip over here because it kind of goes back into how we do data analysis or how we sample a data series. So a line chart, which is the most popular kind of chart, is just a closing price. So most often when you open up your Robinhood, your default chart is going to be a line chart, and that's just depicting closing prices for the day. Still a very meaningful chart, but won't necessarily show you the battle action like a bar chart or a candlestick chart will. Dollar cost averaging. Dollar cost averaging is an investing strategy that buys an equal amount regardless of the price. So for instance, I use a dollar cost average strategy when I'm dealing with the QQQs, which is the top 100 companies in the NASDAQ, right? So every week I buy the same dollar amount of the QQQs because I'm overall bullish on it. Now, to be fair and square, we're definitely down for the year. The QQQs are down about 25%. But this is a strategy that I implement on a weekly basis on things that I'm really, really bullish on. Another piece of key terminology is a downtrend. A downtrend is simply when price action is moving lower, and it's defined by a series of lower lows and lower highs. So the lows keep pushing lowers and your highs keep pushing lower. Another piece of key terminology we'll be going over today is resistance. So resistance is supply. So whenever a price move is stalled or has a problem advancing too high, it encounters resistance. Resistance is symbolic of people that owned it selling it. So it's kind of like a roof above the price action. The antonym of resistance is support. So this is where you have demand in a market and it acts kind of like a floor. So you may be having a decreasing price action and then you find support. Support is when the buyer comes in, the demand comes in. And that's usually the first phase of an uptrend, which is strong demand. So at resistance, you're going to see a strong supply where people are willing to sell it. At support, you're going to see a strong demand where people are willing to buy it. A stop is an order that you use for protection. So let's say I buy XYZ stock at $10. I put a stop at $9, and if XYZ stock falls, I'm going to be protected to just a $1 loss. So even though I invested $10 in XYZ stock, because I put my stop loss at $9, my risk is only $1, which is 10% of $10. So a stop is an order to sell at a certain price, and it's a strong form of money management. And then trend. Trend is one of the most important pieces of terminology that we're going to go over today. A trend is a direction of an asset. So we have uptrends, we have downtrends, and we have sideways trends. Sideways trends are referred to as trading ranges. And the most fun of them all is the uptrend, right? Nobody's having a better time than we're in an uptrend. People are making money. Everybody on social media is, flashing their cash. And, this is the most fun of them all, the uptrend. And that's just a series of higher highs and higher lows. Every high is higher and every low is higher. Okay, so approaching markets. So I want to start with a quote from my favorite author. Well, it might be Robert Greene and Dr. Alexander Elder. I'm sure lots of you are familiar with Robert Greene, author of 48 Laws of Power, Art of Seduction, Laws of Human Nature. But my other favorite author is Dr. Alexander Elder. The markets do not know that you exist. You can do nothing to influence it. You can only control your behavior. And, that's something to always keep in mind because, sometimes you can take price action personally. You can take, your analysis and maybe say it's wrong, and we can take that personally. So you got to realize that Amazon doesn't know that you're alive. Apple doesn't know that you're alive. This is just price action. There's nothing that we can do to control it. We can do our best to analyze it and then profit from it. So ways that we can approach the markets are through the indices, through exchange-traded funds, through company-sponsored and retirements, through private stock trading or private cryptocurrencies. These are all different ways that you can approach the markets. So the indices, when we're talking about the indices, we're talking about the Dow Jones Industrial Average, the S&P 500, and the NASDAQ 100. So when people say the market, and we're talking about the market was up today, the market was down today, the market did this, they're talking about these three indices. So these three indices are basically baskets of stocks, right? So Dow Jones is your 30 biggest companies in the United States, and this is kind of the breakdown. It's 21% health, 17% tech, 14% industrial. You got some defensive exposure and some cyclical exposure. The S&P 500, which is more broad-based, this is 500 companies in one basket. And so its makeup is a little different than the Dow Jones Industrial Average, but they are very, very similar. Also tech exposure, health exposure, cyclical exposure, but then you get into some utilities and energy and defensive stocks in the S&P 500 too. So a little bit more diverse than the Dow Jones Industrial Average, but still very similar and move in a very similar fashion. And then one of my favorites, and definitely a fallen angel this year is the NASDAQ 100. The NASDAQ 100 is the top 100 tech stocks that are made up in the NASDAQ composite. So as you can see, the NASDAQ is almost 50% technology, right? This whole basket is made up of 50% technology stocks, to where the S&P is 25%, the Dow Jones is 17%. So they all have various levels of exposure to different industries. And then stocks. Stocks is another way that we can gain exposure to the financial markets, right? So a stock represents ownership. You own a share of a company. It's bought and sold on most exchanges. Most of the people that I know, they use, Webull, Robinhood, and there is a dividing line with stocks. You have growth stocks and you have value stocks. So your growth stocks are going to be your stocks that are in the NASDAQ 100, tech companies, very small companies, might not be making a lot of money, but have a lot of potential. And then your value stocks are going to be some of your cyclical stocks, a lot of your utility and defensive stocks. When you're talking about the Costco's of the world, the banks of the world, these are value stocks. Then you have exchange traded funds. So in my personal opinion, and once again, this is all in my personal opinion. Well, it's not all, because some of it is facts. But exchange traded funds are very, very underused, and they're really important, and they give beginning investors a really good fighting chance about participating in some of the big trends going on in the market. So exchange traded funds are a basket of stocks. So if I went to a shopping store, to the grocery store, and I got, some pineapples and some bread and some milk, right? All these individual items make a basket of groceries. Well, that's kind of similar to an exchange traded fund. A fund manager goes shopping for individual stocks. They put it all in the same basket, and it becomes an exchange traded fund. So one of the most popular exchange traded funds out there that has just taken a beating is ARK. So a lot of us, know about ARK. It was a very high-flying stock during the pandemic, and it's really fallen from grace. Another popular exchange-traded fund that I like are the QQQs and also VOOG, VOOG. These are growth exchange-traded funds. The most popular exchange-traded fund is going to be the SPY, and that's going to be the S&P 500 in one basket that you can trade. John C. Bogle is the guy that, number one, invented Vanguard, or is the founder of Vanguard, and he also invented the exchange-traded fund. And he said the two greatest enemies of the equity fund investor are expenses and emotions, right? So when we're talking about expenses, we're talking about when you're paying commissions to buy and sell, and then your emotions when you're, personally responsible for picking your own stocks. There's a lot of emotion involved. There's a lot of ego involved, right? And a lot of times that can cloud our decision-making process. So one of the things that we can do is try to look for exposure to exchange-traded funds so that we're not necessarily taking stock picking into our own personal choice of making, but we're kind of looking at different industries. So one thing that I want to tell you guys all to pay attention to is there's a lot of funds called XL. So there's XLE, which is an energy fund. There's XLF, which is a financial fund. And these all have very low expense ratios. We're talking about like 0.1, to where a fund like ARK is going to have an expense ratio somewhere around 0.7, 0.75. So for all the viewers out there today, or if you watch the video later, look at the XL funds. That's going to give you the best exposure to, that's what the professionals use. Let me just say that. That's what the professionals use. When they're looking at strength and what's trending and what's going up and what's going down, one of the XL funds is always doing that because they're sector related. So you have the financial sector, the energy sector, you have defensive stocks, cyclical stocks. So I'm just going to put that out there. The pros are using the XL funds, and that's what we need to be doing too. Company-sponsored retirement is also a very underutilized tool. So we're talking about 401ks if you're working at a private company or a public company, excuse me. Or if you're working for like a government agency or a nonprofit, you're going to have a 403b. And these are both just different sections in the IRS tax code, section 401k, section 403b. But they're all different rules and regulations regarding about how employers can run company-sponsored retirement programs. Now, a lot of people are not maxing out their 401ks, and that's a problem because the 401k typically gives you a company match. So if I'm putting away $5 every week. My company's putting away $5 every week. So theoretically, you're starting out 50% ahead or 100% ahead of your average investor if your company is matching you on every dollar or a portion of the dollars that you're investing. Another benefit of the 401k is it's tax deferred. So the money that you're putting in there isn't even getting taxed. So just imagine how confident I am if, number one, I'm putting my own money up there. Number two, my company is giving me free money to put in there. And number four, I'm not even getting taxed on it. I can sleep really, really good at night no matter what the market does. I mean, I really do. Because I'm already theoretically way the hell ahead, right? So I think all of us need to be a little bit more intentional about the 401k. I think a lot of us need to quit knocking the 9 to 5 because that doesn't define you. And there's a lot of benefits to somebody giving you some free money invested every week, okay? So, and then you have the Roth IRA, which is another form of retirement account. The main difference on the Roth IRA is where these two are typically tax deferred up front. This is tax deferred on the back end. So you put the money in the Roth IRA and you pay your taxes on it beforehand, but when you pull your profits out, you're not paying any taxes. All right, so cryptocurrency. A lot of us are familiar with cryptocurrency, and a lot of us recently have had bad experience with cryptocurrency. It's the crypto winter, right? So, you know, crypto probably hit its high, and a lot of cryptos hit their high in August of 2021, and then some of your bigger names, right, your Ethereum, your Bitcoins, they hit their highs a little later in the year, and they're all down more than 50%. Most of them down somewhere around 80 or 90%, right? So cryptocurrency is a digital asset that's distributed across computer networks. So there's a network of computers here. They're all connected, and they validate the cryptocurrency, right? Now, there's a couple ways that cryptocurrencies are created. One is proof of work, which is a bunch of computers running algorithms and creating new blocks, right? That's why they call it the blockchain. That's proof of work when they're running all these algorithms. They create a new block, and then it's chained to the prior block, right? These are the blockchains. So that's how Bitcoin is created. Now, other cryptocurrencies are created using proof of stake, where proof of stake is basically you put up your cryptocurrency's collateral in a pool, and it stakes it and validates the next batch of cryptocurrency, right? So proof of work and proof of stake both create cryptocurrency. Right now, the big thing is that Ethereum is trying to move from proof of work to proof of stake. So that's supposed to be happening sometime this summer. Ethereum has went from around 4,900 to where today it's trading at about 1,800. So it's, you know, had a significant bear market over the past couple months. But that's one of the biggest upcoming things with crypto this summer is the Ethereum switch from proof of work to proof of stake. You have, once again, powered by blockchain technology, and it's also decentralized finance. So this is finance that isn't dependent upon central governments. This is finance that isn't dependent upon Wells Fargo or JP Morgan. And it's really distributing the financial community amongst ourselves. So that's what they mean by decentralized finance, and that's a really important segment of cryptocurrencies. So the main categories of crypto are the currencies. So your currencies are your Bitcoins and your Dogecoins and your Shiba Inus. These are, you know, theoretically designed to be used as money. Then you have smart contracts. So these are blockchain networks that allow new developers to create new apps. So one of the most popular smart contracts is Ethereum. Bored Apes Yacht Club, that's made on Ethereum, which is one of the, you know, most popular NFTs. Most NFTs are made on Ethereum, but because Ethereum was at one time so expensive, Now people are making NFTs on Polygon and Cardano and Algorand. And these are also smart contracts. So these are basically layers of blockchain that new technology can build upon. And then the third main crypto category is DeFi, which we kind of talked about before, but these are all for decentralized finance. So one way that a lot of people, the most popular investor, Warren Buffett, approaches the market is through fundamental analysis, right? Mad Money, Jim Cramer, he uses fundamental analysis. So these guys are reading company reports and they're trying to measure intrinsic value. They're saying, you know, I'm looking at this company on paper and it's supposed to be about 40 bucks. But when I go to check the share price, the stock is 20 to 25 bucks. So inherently there should be some intrinsic value there, right? So that's kind of what fundamental analysis does. It starts with a top-down approach, which means that it starts with the economy, and then you go down to different sectors. So for instance, the economy isn't doing good. We all know that, right? So then, but we're still got some money we need to invest, right? So let's see what sector is doing good. Oh, oil is doing really, really good. Well, we know gas is high, right? So oil is doing good. Okay, so now I'm going to go even further down. I'm going to look at what stock in the oil industry is doing good. And that's what we mean by top-down analysis. You're taking the economy, and then you're looking at the sectors. Remember the Excel funds, right? That's how you look at what sector is performing good no matter what's going on. One of those sectors is doing good. And then what stocks make up that sector. That's how you do top-down analysis. So technical analysis, which is, you know, my primary school of thought, and once again, I'm not against fundamental analysis. This is just what's comfortable for me. But we believe that we don't necessarily need to know all of the fundamentals. Just show me a chart, right? And that chart is going to show me pretty much everything that everybody thinks about this, you know, in total, right? So we believe that prices move in trends. That means, once again, higher highs and higher lows, or lower highs and lower lows, or sometimes sideways. That's also a trend. And we also believe that history repeats itself. So moving averages are one tool that a technical analyst uses to understand what's going on in the market. And a moving average is essentially an average over a series of time, right? So a 10-day moving average says that over 10 days, this is the average price. A 20-day moving average says that over 20 days, this is the average price. So we're going to go to a chart here, and let me see. So this, we went over this series a month ago, right? So right here we had moving average. This is the triple Qs, which is the top 100 NASDAQ companies. Now this is 1 month ago we looked at this chart, and we said that the main message of these moving averages, so I have a 20-day moving average, that's my fast moving average, and we have a 50-day moving average. So this line represents the average price over 20 days. This is the average price over 50 days. So
color line
yeah, the blue line is the 20-day. The red line is the 50-day. So back in May, we said, what's the most important message of this average? Well, the most important message is the direction. It's saying down, right? Now there's another message. This is kind of far away from both of these, so it was saying maybe overextended, but overall the most important message was the trend is down, right? And so let's go to where it's at now. So this was kind of where we viewed it 4 weeks ago. This is a weekly chart, right? So it's updated, you know, weekly since then. And lo and behold, the message was right. The trend was down. And so if you listen to that, you would probably have stayed out of some trouble, right? So that's the most important message of a moving average, is what direction it's going. So support and resistance, we talked about that before, and once again, this is technical analysis, but support is a floor. So I'm standing on a floor right now, and it's supporting me, right? Well, that's what support is in the financial markets. Prices decline, and then they hit a floor. What is the floor? Well, the floor is where people say, this is a damn good deal, and everybody buys, right? For Bitcoin, that used to be about 30,000. Now people aren't so sure about 30,000. But the floor is, you know, where there's support, where buyers come in, and where you see a surge of volume. Resistance is the opposite, right? It's a price move that is stopped above, so it's like the roof above me, right? If I jumped, I would eventually be stopped by the roof, right? If I could make that part high, of course. Right, I probably could. But yeah, I would be stopped by the roof, right? There would be, you know, so in finance or in technical analysis, it's the same with price action. Resistance is a roof above the price. So 30 days ago, approximately 30 days ago, this was the chart. This is a month ago. And we drew this line here, this first blue line. We said, this is looking like support, right? It looks like somewhere where buyers might come in. And then, once again, this is Apple, excuse me. This is a chart of Apple. That's really important. So we thought this might be a area of support, but we also drew this line here, right? Because we're saying, you know, it looks like there's a lot of price action in this area. Before this area acts as resistance, one of the rules is that resistance sometimes acts as support. Support sometimes acts as resistance. These areas on the chart, they switch roles, right? So we drew this line here just saying that if this didn't act as support, let's see if this line acts as support. And lo and behold, that line acted as support. Now, I'm not a magician and I didn't know that, but I do believe that history repeats itself, right? And so do most technical analysts. And so I'm looking at prior highs that used to be resistance, and now, after this move right here, they're acting as support. So it used to be a ceiling above the price, and now it's a floor for the price. So that second line we drew, just in case, it did what we call a bear trap. It touched it, faked a few people out, and now it's ready to roll. And then this candle right here, we're going to talk about candles later, but this is a bullish engulfing candle where it's just a beautiful candle. So yeah, that worked out. It's too much for right now. Okay, so Amazon. So last time, this was 30 days ago, we drew support right here. And now Amazon is really, really important because this week, Amazon is undergoing a 20-for-1 stock split. So if you own 1 share of Amazon, you're going to wake up this week and have 20 shares of Amazon. But instead of your 1 share being worth about $2,500, you're going to have 20 shares worth about $125, which is really, really bullish for the stock because obviously, you know, we all know what Amazon does. It gets money, they do big business, and their stock has been bullish over the last 2 decades. Well, now the price is going to be really, really cheap again. It's going to be $125 a share. So what do you think that's going to do for demand for the stock? What do you think that's going to do for the person that wasn't able to afford it at $2,500? It's going to be probably bullish. But let's see what happened to Amazon support since we last drew. Snap. It did not hold. Now, there's no rules. Once again, you know, we're only dealing with probabilities, but it didn't hold, right? And we probably should have drew a second trend support resistance line like we did with Apple. But Amazon went down almost to $2,000 since then. We draw a line there. It went down another $500 to $2,000, and then more beautiful candle pattern action here. This is beautiful. This is a tweezer bottom with a gap. I mean, just so much going on here. But this is bullish. But it shows you that sometimes your patterns can fail, and that doesn't mean that you were wrong. That just means that the pattern failed. Don't take it personally.
When you say you gotta be specific on the price that you're talking about.
Okay. So price envelopes. Price envelopes are another tool that technical analysts use. Price envelopes are used to distinguish value, right? So price envelopes are bands. We went over moving averages a couple minutes ago, but it's basically a band that's parallel to a moving average that helps you distinguish too high and too low. And they should contain about 90% of the price action, and they're used with other filters to interpret overbought and oversold conditions, which is something that we're going to go over to in the next series. All right, so this is a chart of Tesla. So Tesla is currently trading at about $700, and these are the price envelopes, right? So I got a blue line above it and a blue line below it. And these have done a pretty good job of containing the price action. So typically when Tesla pokes up above this, for the long term, that's very bullish. Whenever a price blows out of these bands, it tells you that, you know, over the near future, you're going to see higher price action in that direction. So, but for the short term, that means it's bearish because it's a little too high for the moment, right? So every time Tesla hits this line, it's good for the long term, but bad for the short term, right? Hit this line again, and you know, blew out of it, right? Bad for the short term. So these lines, moving average price envelopes, they just kind of help you stay safe. You don't want to be buying when it blows out of the channel, and you don't necessarily want to be selling when it falls out of the channel. Doge is another, you know, popular coin. This chart was from about a month ago, but you see once again, price envelopes are just bands around, you know, the price action. And they just kind of keep us out of trouble and let us know which low is a little too low, which high is a little too high. So Doge, every time it shoots out of the boundary, it comes back, right? And this is where most people get excited, right? You blew out of the boundary, volume was really, really high, sucked a lot of people in, and then went the opposite direction. So it lets us know when too high is too high and when too low is too low. So the industry, well, the financial industry doesn't exist without you and me, right? They need fresh money coming in, authors need to sell books, brokers need to make commissions, and so it is an industry. So we need to be mindful about, you know, our expenses and our expenditures when we're in the trading industry. A lot of people are going to try to sell you a lot of products, just like in any endeavor. Whatever business you go into, there's going to be vendors there, right? Well, the financial markets are no different, so you want to look for brokers with the cheapest commissions. A lot of brokers these days have $0 commissions. You want to look for courses that are reasonably priced. You want to exhaust the ones that are free, try to get as much information for the most value that you can. And you also want to be mindful about the books that you buy, right? Because some books beget books that just take you down, you know, the bad road, right? So you want to look for books that have a decent bibliography. You want to look for books that are referenced in other books, and you don't want to pay too much for your trading education until you're really, really sure about the source. Investor psychology. So investor psychology is not something that you hear about a lot because it's not beneficial for you to know about it. But when you're dealing with investing, when you're dealing with economic utility theory, you're dealing with investor psychology. So investor psychology is individual psychology, mass psychology, and there's a new form of finance called behavioral finance that actually is a college course designed to discuss the psychology behind financial making decisions, right? So individual psychology is affected by wins, it's affected by losses, it's affected by fear of missing out, And these are all different emotions that we need to manage while we're managing our portfolios also. So you're not just managing a basket of stocks or cryptos, you're also managing how you feel about those, right? Mass psychology refers to crowd behavior. So technical analysis is basically, you're taking price action and you're analyzing it, but you're also looking at psychologically what are all the participants thinking about this stock or this cryptocurrency, this commodity or this bond. Portfolio management. Portfolio management, it's about risk. That's essentially what portfolio management is about. It's about managing risk. So risk, all investments involve risk. All funds are going to disclose that to you up in front. They're, obligated to by law. But understanding this and learning how to reduce or mitigate risk is very, very important and something that you can do. So once again, when I pointed you guys to the Excel funds, that's one way that you can manage risk because you're dealing with markets that are correlated or uncorrelated, right? So one of those markets is always going up. Something is always going up, but what's going up? What's correlated and what's not correlated, right? So cryptocurrency and the NASDAQ, right? I own both of those, but if I don't own anything else, then I have very, very high risk because they're very highly correlated. Stops, we talked about those earlier, but stops are stop losses. So I put in an order for Amazon at 2,500 and I put a stop loss at 2,400, so I'm only risking $100. Yes, I invested $2,500, but because I put my stop at $2,400, my risk is only $100 per share. And then money management is the process of allocating investing capital, and it's also your money management when you're doing trading. So when you're trading, you're only risking a certain percentage on every investment, and over the course of a month, you have a limit to where you're only allowed to lose a certain amount every month, and these are different implementations of strategies of money management, right? So traders have, really firm money management rules. Investors can be a little bit more relaxed with money management, like per investment risk, because they have a longer time frame. But a trader has really, really crisp stops, has really, really firm money management. So I want to open it up. If anybody wants to type in any Q&As, we'll just be here for a minute to answer those. But in the meeting between time, if I don't get any Q&As, I wanted to let you know that next month we're going to be going a different direction and talking about how to really select the markets that we want to trade and how to implement investing strategies. So this was Financial Markets Explained, really, really introductory, but we want to take it up another level. We want to take it from a definition presentation to an application presentation. And so how do we select the markets that are strong? How do we select the stocks in the sectors that are strong? And how do we go about rotating our investment and our portfolio, okay? So that's going to be next month. That's going to be the first Sunday in July. And yeah, if you have any questions, let me know. Any questions coming in?
Not yet. No, you're doing good. Just stay like that for a second so they can see the screen for your info.
Oh yeah, last thing, shameless plug. Always, this is based on This Way to Wall Street. You can catch it at a space inside, or check out the website, www.mactuggle.com. But not necessarily for the support, but just for your own development. If you're interested in everything that I was talking about today, or anything that I was discussing today, This Way to Wall Street would be a good starter for you. No questions? We can stop it. All right. Well, I'm not getting any questions. You guys are being shy, but hopefully, you won't be so shy next time. But thank you for watching. Thank you for joining me. This will be uploaded on my YouTube. So if you didn't catch it live, we'll be running it back on there. But thank you so much, and we'll see you next month.